What's up, everybody? Erik here with a video on Wall Street versus retail traders. I think this is probably one of the most misunderstood financial sectors in existence. And I think retail traders have a gross misunderstanding of how we fit into this larger financial picture. So this video is designed to do a few things. First, I want to lay the groundwork on how retail trading differs from Wall Street, really institutions, professional traders, prop desks, market makers, things like that. And then the other thing is I want to share some specific information that we need to make sure we are taking seriously if we want to be successful traders long term. So first off, let's start with understanding Wall Street versus retail. So again, Wall Street, I'm referring to professional traders. I'm talking about institutions. I'm talking about market makers. I'm talking about brokers in some capacity, specifically if they're broker dealer. I'm talking about investment banks, things like that. That sums up to smart money versus dumb money. And I'll give you one guess who the dumb money is. It's us, the retail traders. We really need to understand and accept the fact that the cards are as stacked against us as possible. Now, I know what you're saying. Erik, we have the best internet connections available, access to the markets, educational materials. You do. You are being fed a very specific narrative by a ton of people with tremendous conflicts of interest to give you that narrative. So I'm not saying that we're in this, completely unwinnable system. I've been trading for 14 years now, and I have a successful compound annual growth rate that is in excess of the market. However, my alpha at all points may not have looked great. I'm definitely used leverage historically to outpace the markets, which isn't great long term. The other thing is just understanding that our place in the market is essentially the bottom feeders. The institutions get all of the information, have all of the computing power that we could possibly just imagine. We are the tail of the dog. We get the scraps, we get information last. Everything we see has already been known and digested by institutions for probably significant periods of time past. So, a couple things to note right out of the gate. Professional side of trading is very methodical. It is quantitative in nature. They use long and short positions in their portfolios. Again, speaking very broadly, you're going to see 10 to 30 positions on a prop desk at a point, depending on, what they're doing. Retail traders, very different. We're emotional, we're random, we're disorganized. We have concentrated risk profiles. We trade the same kinds of things. We do the same strategies in the same time frames. That is one of the biggest issues that retail traders have, is we have no real grasp on how to manage a portfolio successfully. Some people will decide, I like to trade short puts that are 45 days to expiration, managing them at 21 days to expiration because Tasty Trade told me so. That might work in some market conditions. That does not work in all market conditions. One of the most important things for early traders is to gain as much exposure to different strategies, different securities, and different time frames. Because if you're a one-trick pony in the market specifically for trading, you will not be successful. The market is too dynamic. There are different circumstances that different approaches best fit. Our real job as traders is to see what the market is doing and figure out the tools from our toolkit that best fit those scenarios. Another couple really important understanding for retail traders, just as it comes to broad behaviors. Most have smaller accounts. Most it's like $3,000 to $5,000 based on a study by Fidelity of their brokerage firm. Robinhood, it's even less still. You can kind of see it across different time frames, but the vast majority have small accounts. The other thing is traders have horrible psychological understandings of themselves. They do this thing where they bargain buy. They want to find good stocks that have been beat down 50% and then enter. That is dumb money. There's a reason why it's beat down, and retail traders think that they're onto something that the rest of the market isn't. More often than not, they're not. We also tend to hold losers for prolonged periods of time because we have confirmation bias. We don't want to book a loss, and we sell winners prematurely. Again, same confirmation bias where we want to realize gains. Now, moving on to the exchanges and order flow. This is a really important conversation. Right now, the exchange is essentially a duopoly. We have the ICE, who owns the NYSE, New York Stock Exchange, and then we have the CME, who owns the CBOE, NYMEX, and COMEX. So what this means is the exchange is the entity that essentially is clearing all trades at the end of the day. So you need to have good competition to have a fair exchange environment, which we really don't right now. So for those that don't know, the flow of a trade from a retail perspective essentially is going to go from a retail trader to a broker to an IB firm of some sort, and then it's going to end up on the exchange. During this chain, there is a series of interactions that is extremely disadvantaged for the retail trader, and then there's also significant conflicts of interest that exist between all of these. So first, let's start with the broker, the people that we are actually submitting our trades to. How do brokers make money? Well, they make money on commissions, they make money on spreads, they also make money on financing turns, which is kind of a different discussion that we'll brush over, but commissions is what they make based on each trade that's put in. It used to be on stock as well, but there's no commission stocks now. So they're mostly going to be making commissions on derivatives products, and then they're also going to make money on spreads. Spreads is the difference between the bid and the ask of a product. And then financing turns is essentially their loaning series where they have margin that they send out to different entities and collect interest on, short stock, and also taking sides of trades. So what is the broker paradigm? If they make money off of commissions, and if they make money off of spreads, if they make money off of financing turns, how do they make money, and how does that influence their paradigm? Well, they want retail traders to trade as much as possible and as large of sizing as possible. They are incentivized to make you trade. That is why you have free education. That is why you have access to all sorts of market information that we hadn't seen before. This is not because they're trying to help you because they like you. They want you to trade more because it is how they make money. And then finally, this is kind of a really frustrating component. Let me actually move this up just a little bit so that you can see more clearly. So we have things called introducing broker agreements, IB agreements. And essentially for educators that team with a platform, in the US, they have a flat rate commission, meaning that they make X number of dollars for teaching, the broker's constituents. Whereas across the rest of the globe, except for Singapore, it's actually percentage based. Now, even though it's not percentage based like the rest of the globe, it's really important to keep in mind those flat rate commissions, because if the broker wants you to trade more and you have an educator whose boss is the broker, don't you think that the educator is also going to be pushing you to trade more? Because if you don't think that, you're gravely mistaken. The education that you are getting from any sort of broker entity, free, could be good, but it has an ulterior motive based on that conflict of interest. The broker wants to give you access to the market. They make money in those ways that we explained. Anybody that's teaching you through a broker is incentivized to get you to trade more because that's how their boss makes money. All right, let's talk about options now, specifically. From an options perspective, So there used to be a product called contracts for difference, and essentially is the ability for brokers to make money on the opposite side of your trade. Now, after the financial collapse in 2008, 2009, they were banned in the US because retail traders were losing their shirts with it. So options started to gain a lot of popularity really in their place because CFDs were a form of derivatives and options essentially filled that same gap, providing leverage. Now, the thing to know about options for retail traders is unlike a security, options are time bound and they have this really important component of implied volatility that influences its price greatly. Now, 70% of options, give or take, depending on the time frame that you look at, will expire worthless. No real retail trader has looked at that and not said, well, if they expire worthless, why not just sell? There's a reason for that, which we'll get into in just a minute. Now, an important breakthrough here is answering these two questions. Why do retail traders that want to trade options simply not just buy or not just sell? Well, let's answer that question. So, even though 70% of options expire worthless, why don't retail traders then just sell? A common analogy used in industry is it's like picking up pennies on a train track. You're getting a little bit of money here and there because if we're selling options, we're collecting a credit. It's a defined profitability trade with undefined risk. So you're collecting this small amount of money and you essentially need to not get hit by the train, which is an outsized move. If you sell a call and you go to bed, you wake up and all of a sudden it rallied 40% based on great earnings output or a buyout news or something like that. It can essentially erase in a portfolio, specifically if you don't have enough capital in it to make sure you can survive. So selling, it's not a scenario where all that glitters is gold. You are essentially collecting small amounts of money, trying to avoid the inevitable large moves that can erase you as a trader. Why not just buy then? Well, it's mostly because of this right here. Retail traders suck at adequately pricing options, specifically implied volatility calculations for options. So what that means is if we are just buying all the time, there are certain market circumstances that benefit buying and certain market circumstances that benefit selling. You cannot be a one-trick pony in the markets, as we already talked about. You have to be able to identify current market scenarios and apply the right tools for the job. Retail traders are not great at that. A lot of retail traders just fall into, they do X style trade in Y time frame, and that's it. That is not sufficient to make money in the markets. Again, the professional traders are not doing that. They have varied positions that they have very defined rules associated with to be successful. So, in retail trading, I think it's super important to understand how we fit into this picture. We are the bottom feeders, we are the tail of the dog, and we need to find ways to behave more like professional traders in order to, one, survive, and then two, thrive to make money. Because we have some benefits that professional traders don't have. We're not responsible to anybody. So we can go through different market cycles, accepting different movements in our portfolio as part of a greater plan that may not be sufficient for professional traders. They might be forced to liquidate at certain points during a trade cycle because risk simply got too high, even though the trade might work out. We have the ability to access the markets in a way that professionals can't. We're not trading at the size they are. So we can enter and exit positions much more easily than they can. So it's not all disadvantages for retail traders, but structurally, there are a lot of them. So it's our job to understand those structural disadvantages, understand what advantages we do have, and leverage that information to become successful traders and to be an outlier. So as always, if there's any questions or anything, let me know. And until next time, I'll catch you all later.